Here is the strange picture today, Saturday, August 15, 2026. US economic data is softening, yet the Japanese yen is not rallying. US dollar to Japanese yen is holding near 159.40. US producer price inflation was unchanged in July, and the latest consumer sentiment reading is weak. Normally, that would push the dollar down and give the yen a lift. So why is the yen still stuck near levels that officials spent billions defending weeks ago? The answer is that two forces are canceling out. Soft US inflation data is pulling the dollar down, while Japan's own weak fundamentals and higher energy costs are holding the yen back. This is not just a dollar story. It is a currency that refuses to strengthen even when conditions improve around it. Look at the path here. In late July, the yen slid to about 164 per dollar, its weakest in 40 years. That triggered official intervention, reportedly around 8.45 trillion yen, or roughly $53 billion. On Monday, the dollar dropped about 1% to 156.34 yen before drifting back to 159.40. Wednesday's US CPI met expectations, which helped the dollar gain and the yen slip. The Bank of Japan held rates steady, and analysts such as Brad Setzer argue that US support for intervention can only succeed if the Bank of Japan actually raises rates. Markets are now pricing in faster BOJ hike talk, but higher energy prices keep longer-term inflation risks tilted upward. Policy has shifted from emergency defense to a waiting game. Here is what this means in practice. A weak yen raises import costs for Japanese households and businesses, especially energy. Japan holds about $1.2 trillion of US treasuries, more than any other country. If the yen falls sharply again, Japan could face pressure to sell US bonds to fund intervention. That would push US Treasury yields higher and tighten financial conditions globally. For traders, US dollar to Japanese yen remains sensitive to Treasury yields, not just US data. Soft PPI did little because yields and energy prices are still doing the heavy lifting. For UK viewers, the lesson is direct. A disorderly yen move would ripple through global bond markets and risk appetite. The near-term path depends on two triggers. First, whether US Treasury yields fall enough to drag US dollar to Japanese yen below 158 and then test the 156.34 area seen on Monday. Second, whether the Bank of Japan signals a genuine rate hike at its next meeting. If the BOJ only talks and does not act, any yen rally is likely to fade. Energy prices complicate the picture. Higher oil and gas prices keep Japan's import bill high, which weakens the yen over time even when US data softens. For now, 160 remains the line in the sand. A clean break above it could force another official response. The takeaway is straightforward. Soft US data alone cannot rescue the yen. Until the Bank of Japan changes actual policy, not just tone, US dollar to Japanese yen is likely to stay trapped between 156 and 160. Watch the 160 level. That is the number that forced intervention before, and it remains the clearest signal of what happens next.